Hello and welcome to Business Incorporated. I'm Chimeze Obi Iwago. Coming up on the show today, Nigeria's inflation rises to 12.82% in July from 12.56% recorded in June. Ghana's fiscal deficit seen narrowing to 9.4% in 2021. And Congo's central bank makes huge rate hike to 18.5%. We begin the show with Nigeria's inflation rate, which rose to 12.82% year-on-year in July, indicating an increase of 0.26% from the figure recorded in June. Data just released by the National Bureau of Statistics shows that on a month-on-month basis, the headline index increased by 1.25% from the 1.21% recorded the previous month. Food inflation rose to 15.48% in July 2020 compared to 15.18% in June due to increases in the prices of breads and cereals, potatoes, yam and other tubers, meat, fruits, oils and fats. The urban inflation rate increased to 13.40% year-on-year in July from 13.18%, while the rural inflation increased to 12.28% in July from 11.99%. On a month-on-month basis, the urban index rose by 1.27% in July from 1.23% recorded in June, while the rural index also rose by 1.23% in July from June's 1.19%. And to intraday market numbers now, major markets here in Africa were mixed. The Nigeria's main index was unchanged, while South Africa's JSE index declined marginally by 0.07%. The EGX 30 in Egypt was higher by 0.42% at intraday. Kenya closed negative on Friday. And major stock markets in the Gulf rose at intraday except the Saudi index, which declined 0.29%. The Qatari index gained 0.95%, led by a 1.5% rise in Qatar National Bank, the Gulf and Africa's largest lender. Elsewhere in the UAE, Dubai's main share index jumped to 1.04%, supported by a 2% rise in Emirates MBD Bank, while Abu Dhabi's index rose 0.41%. And stocks in Asia Pacific were mixed today as tensions between the U.S. and China continue to weigh on investor sentiment. Mainland Chinese stocks were higher. The Shanghai Composite jumped 2.34%, while the Shenzhen component added 1.877%. Hong Kong's Hang Seng Index gained 0.65% to close at 25,347.34, while Japan's Nikkei 225 slipped 0.83%, and the Topix Index dipped 0.84% to end its trading day at 1,609.82. Shares in Australia declined, with the S&P ASX 200 down 0.81%. Overall, the MSCI Asia ex-Japan Index advanced 0.32%. Markets in South Korea were closed for a holiday. And U.S. stock futures rose this morning after Wall Street logged its third consecutive weekly gain, but fell short of breaking the all-time high set on February the 19th. Dow Jones Industrial Average futures were up by 87 points, while S&P 500 and Nasdaq 100 futures both traded in positive territory. The S&P 500 climbed 0.6% last week, and the Nasdaq Composite advanced 0.1%. The Dow gained 1.8% last week. Despite those gains, the S&P 500 failed to notch a fresh record high after flirting with a milestone for most of last week. All right, let's see what's happening in the UK as fears of new COVID-19 lockdowns and travel restrictions are hitting shares in airline and hotel operators. Our airline operator, IAG, was the top FTSE 100 faller, down 2.6% in the morning, back towards the 7-year lows hit earlier this month. Holiday Inn 09 Intercontinental Hotels lost 1.6%. On the FTSE 250, holiday operator TUI had fallen by 4%, and cruise operator Carnival was down 2.5%. Let's get the intraday numbers from Simon. Hello, Simon. Good afternoon again. So bring us up to speed with the intraday numbers. Are the shares of airline and hotel operators still battered?
Yeah, good afternoon. Yeah, it's a volatile time really, isn't it, in terms of the hospitality industry especially. The FTSE 100 has recorded a modest rise since the morning as a key week in assessing the impact of the coronavirus and Brexit on the economy kicks off. Economists later this week will be analysing a whole load of data, official figures last week, of course, confirming that we are here in the UK in a recession. Some up and down news to start the week for markets here. As you said, airline and holiday companies are being hammered by the news that people travelling to France will have to quarantine for 14 days. France is a big market here in the UK. The largest travel company in the world, TUI, you mentioned, they're down 4.2% at the moment, while the company that owns British Airways is down even more, 4.8%. But good news for the housing market here. A boom in sales over August saw £37 billion worth of property being sold. That news coming out this morning. So generally things are kind of steady here. The FTSE All-Share is up by 0.2%. The FTSE 100 up by around the same amount, while the FTSE 250 is steady too. Looking at the currencies, the pound is up slightly on the dollar, up the same amount on the euro, and down very slightly on the yen. Japan's economy obviously not in a good place right now, as we heard from those GDP figures earlier, down 7.8% on the same period last year.
And about 39,000 people successfully made claims an hour and a half after the second scheme of the government's self-employed support grant opened. And Chancellor Sunak says this will be the final handout. How successful was the first scheme, and any idea what happens to those who miss out on the last scheme?
Yeah, so this is colloquially known as the Furloughs Scheme. So millions of self-employed people whose trade had been hit by coronavirus can now apply for a second support grant from the government. More than 3 million people may be eligible for the payment, which is up to £6,570 each. And as you say, lots of people logging into that government website today to make their claim. HMRC said it was pleased with the positive start the second scheme had made when it opened. The costs so far of these schemes have been about £63 billion. That's for both the self-employed and the employer furlough schemes. The Chancellor would argue that hundreds of thousands, if not millions of jobs would have been lost had he not stepped in with these schemes. But it's hard to say how successful it's been at the moment without knowing what's going to happen in the future, how many people are going to lose work and lose their jobs, and how the country is, of course, going to be able to pay back those huge debts. This second claims window that we're talking about now is initially open for a 4-day period, but anyone who thinks that they may be eligible but haven't been contacted by HMRC has until October to make a claim, so about 6 weeks yet to make that claim.
And the latest household finance index just released by the IHS Markit shows that household spending fell again this month as that take-home pay declined, and people are increasingly worried about their financial prospects and the risk of losing their job. Can you tell us more about this data?
Yeah, so unsurprisingly, with people losing their jobs and with local lockdowns being enforced in areas around the UK, household finances are not in a great shape. Cautions surrounding non-essential expenditure continued in August, with UK households seeing a further reduction in their overall spending. The rate of decline did ease from July. I think the good weather in August has really helped people go out and spend a bit more, but things have not been helped by a falling cash availability, with a marked reduction in the amount of cash available to UK households. Job security, incidentally, and the perceptions around job security are also negative. Households still more pessimistic regarding their job security than at any other time since April 2011, with some businesses still impacted by lockdown measures or yet to fully reopen. Workplace activity declined further in August, according to UK households. So unfortunately, it's more bad news, and I think there's probably more to come as we kind of weigh up the situation and where everyone is. Obviously, people are coming out of lockdowns and people are being encouraged to go back to work, but there's still a lot of uncertainty in the markets, and this is just another piece of the puzzle that shows that things are still pretty bleak out there.
Right, thank you very much, Simon. Well, we'll continue to keep a tab on those developments as the week rolls by.
Thank you.
And in Europe, stocks fluctuated this morning amid a choppy start to the week's trade, with geopolitical tensions and concerns over the spread of the coronavirus on investors' radar. To talk more about this from the European space is Ulrich Barth. Hello, Ulrich. Good afternoon. Good to see you. Well, there are signs of a second wave of infections hitting Europe, including Germany. Germany has issued a travel warning for most of Spain, and testing is mandatory for people returning from high-risk areas. There is also a profound concern about the economic effects. How is that affecting financial markets? Well, I guess we're yet to connect to Orich there, but let's look at what's happening on the global oil market as prices climbed higher in early trade today, lifted by China's plans to ship in large volumes of U.S. crude in August and September, outweighing concerns over a slowdown in demand recovery after the coronavirus pandemic and an uptick in supplies. Brent crude rose 0.5% to $45.01 a barrel, while U.S. West Texas Intermediate crude was up 0.6% to $42.28 a barrel. Chinese state-owned oil firms have tentatively booked tankers to transport at least 20 million barrels of U.S. crude for August and September as China ramped up energy and farm purchases ahead of a review of the Sino-U.S. trade deal. Record crude imports from world's top importer China and the easing of COVID-19 restrictions globally have supported oil prices, although new waves of coronavirus outbreaks in several countries are expected to cool consumption again. All right, back to Orich. Orich, thank you for joining us again. Well, we're talking about signs of a second wave of infections hitting Europe, including Germany. And I said that Germany has issued a travel warning for most of Spain, and testing is mandatory for people returning from high-risk areas. There is also a profound concern about the economic effects. How is that affecting financial markets?
It's making them extremely nervous. You can see that in the back and forth. You mentioned it yourself just a minute ago that the markets, not just here in Frankfurt but elsewhere, are fluctuating. But they're fluctuating within relatively tight boundaries. And that's, of course, not least due to the record-breaking stimulus packages that the governments but also the central banks are offering to the markets. Yet the market does react at a moment's notice when news comes in on the good side, for example, that there might be a vaccine coming up from a certain company, or on the bad side that there are travel restrictions, for example, that are being enacted, or the number of infections going up. On a whole, the markets are here in Europe, as they are in the United States, for example, still close to record highs, if not at record highs in certain shares and in certain indices. But you can see that the investors are worried, that they're nervous, that they're risk aware on the other side by looking at the safe haven side, gold, silver, also, of course, bonds, sovereign debt of preferred countries. All those also very, very high levels.
Now, the U.S. election campaign is kicking into high gear. The Democratic convention starts today. Is everybody in Frankfurt following that as well? And who is the preferred candidate for stock market people you talk to, Trump or Biden?
Yeah, I don't think I know anybody here in Frankfurt or anywhere else in Germany I talk to who would prefer Trump as U.S. president. But when you look at the market, the people who are in the market say we're of two minds. For the heart, we would be voting for Joe Biden. He's the better candidate. He seems the better personality, not least since the choice of Kamala Harris as the vice presidential candidate. But the people say when you look at the market performance, what Donald Trump has done for the market ever since his election, that's certainly something to ponder, and not a few, if they were able to vote for him, would vote for him on that fact alone.
Now, on Friday, a German biotech firm went public on the Nasdaq. CureVac, which is working like many others on a coronavirus vaccine, is a company that the German government has indirectly invested in. Public money for private companies. How controversial is that in Germany?
It remains controversial. The German government thought it was necessary because the U.S. government was casting an eye on CureVac and wanted to gobble it up so as to have the development and a possible vaccine for itself. And I think a lot of the people here in the market, professionals, but also private investors, more than understand the need for such a strategic move. Even if it is unusual. Of course, the government also has a 20.5% stake in Lufthansa as well in order to save it from going under. But today, the chief of the Monopoly Commission here, which is an advisory body that advises the federal government in Berlin, Achim Warmbach, said, We don't agree with the government taking a stake as long as the coronavirus sits in there. We understand that, but as soon as that ends, the government has to get out.
Thanks, Oricha. Well, the week has just started, so we'll continue to keep a tab on those numbers coming in. Thank you. We'll take a quick break, and when we come back, there's more on the board. To stay with us. Interest rates in Nigeria's debt instruments, particularly the 12-month Treasury, has dropped to a 10-year low, while the Naira has been devalued twice against the dollar this year, risking losses when the capital is repatriated. With their cash-stranded, funds have few choices but to pack in short-term debt while they wait for the central bank to resume foreign exchange sales that were halted in mid-March after lower oil prices dried up dollar supplies. Well, joining me now to talk more about this is the practice lead Sub-Saharan Research at Dorca Frontier, London, William Atwell. Hello, William. Thank you for joining us. Good afternoon.
Hi. Pleasure.
So we traded in equities on the Nigerian Stock Exchange down 57% in June from a year earlier. It appears investors are increasingly wary of the Nigerian market. What's driving this investor caution?
So there are a number of things. The one really relates exactly to what you mentioned earlier regarding the risk affecting repatriation. Foreign investors very concerned about not being able to repatriate their funds, or of course being exposed to very severe losses if and when we see a currency devaluation. So that's of course reducing their appetite for Nigerian equities and bonds. So certainly a big driver there. Of course, domestic Nigerian investors also have been very cautious, and they, of course, are very close to the woes affecting the Nigerian economy, the real economy, if you like. They're very aware of the fact that the economy's been underperforming for some time and has really been hit by the oil price slump. They're also very aware, of course, that there's been very limited progress on things like economic reform and generally rather pessimistic about the prospects for reform looking ahead. So both on the domestic front and from the perspective of international investors, there's really a lot of skepticism and a lot of caution when it comes to investing in the Nigerian market.
Now, do you see any easing in terms of foreign exchange restrictions in the coming months, which is so clearly top of mind, especially for foreign investors?
So not in the short term. So I wouldn't say in the next few months will we see a drastic more flexibility in terms of foreign exchange availability. Looking ahead to next year, we would, of course, expect a bit more devaluation of the Naira. That's just going to be a necessity, even if the authorities, if it's not indesirable from their perspective. But we would see a bit more devaluation of the Naira as foreign exchange reserves really come under even more pressure as a result of continued low oil prices. And of course, limits in terms of production that we're seeing as well. So foreign exchange reserves being under a lot of pressure, just going to force their devaluation during the course of next year. That could enable a little bit more flexibility in terms of foreign exchange availability. So that'll be a bit of relief for investors, but certainly by no means solving the problem.
Now, looking to the wider region and taking it into consideration the heightened risk environment created by COVID-19, which countries are investors looking to make decent returns, and how are they managing their risk exposure?
Yeah, there certainly has been an increase in terms of interest in emerging markets, given the very, very low interest rates, in some cases, 0% interest rates in many developed markets. There's still a huntable yield, and we expect that to continue through H2 this year and into next year as well, as interest rates stay low in developed markets. So really what investors are looking for is appropriate risk exposure for their investments. We expect interest in emerging markets, but in relatively lower risk emerging markets. So some of the more frontier SSA markets, perhaps less interesting for portfolio investment at the moment, but some of those larger, stabler markets where there's some decent return, Kenya, for instance, Ghana to some extent as well, are potentially quite interesting for financial investors going into 2021 and beyond as well.
All right, thank you very much for your time, William.
My pleasure.
William at 12 is the practice lead sub-Saharan research at Docker Frontier, London. And Ghana's fiscal deficit is projected to narrow from 11.4% of gross domestic product in 2020 to 9.4% in 2021. According to the Finance Ministry, the deficit will narrow further to 6.4% in 2022, 4.9% in 2023, and 3.2% in 2024. And the Central Bank of Democratic Republic of Congo has raised the main interest rate to 18.5% from 7.5%. The regulator had lowered the rate from 9% in March in order to cushion the economy from the impact of the coronavirus crisis, following similar actions by African central banks as the virus spread across the continent. The latest rate hike was carried out to re-anchor inflation expectations, which stood at over 14% in July. The central bank says it expects the economy to contract 2.4% this year, compared with growth of over 4% in 2019, partly due to coronavirus-linked disruptions to mining, which accounts for a third of national output. And Dubai's Chamber of Commerce and Industry says Dubai's trade with Africa could see an annual increase of up to 10% over the next 5 years, following the implementation of the African Continental Free Trade Agreement. According to the Director of International Offices at DCCI, Omar Khan, AFCTA will offer a huge opportunity for UAE investors who will be able to do business on a single set of trade and investment rules across the African continent. Khan describes Africa as a market of strategic importance for Dubai and notes that Dubai Chamber's representative offices in Ghana, Kenya, Mozambique, and Ethiopia are facilitating Dubai-Africa trade and investment by identifying new business opportunities for chamber members in various African markets and exploring new avenues of economic cooperation. Dubai's trade with Africa has increased significantly over the last 5 years, registering a compound annual growth rate of 11%, while imports from Africa increased by 14%, exports increased by 13%, and re-exports by 6%. Prices extended losses earlier today after their worst week in 5 months on lingering risk appetite, while the Sino-U.S. trade relationship hinted at potential improvement. Spot gold was down 0.5% at $1,934.91 per ounce, while U.S. gold futures eased 0.31% to $1,943 per ounce. Among other precious metals, silver slipped 0.6% to $26.25 per ounce. Platinum rose 1% to $945.55, and palladium gained 1.6% to $2,143. And that's a wrap on the program. Thank you for watching. I'm Chimeze Obi Iwagu.